Good morning, Brenden Rendo with the Homes in Orlando team, joined again by Joseph Dionne. I don't know what the 136-1176 is, but hey, from Appli Home Loans.
My NMLS number.
Well, is that what it is? That's your NMLS number? Oh.
Yeah. That's but I guess I'm using a different computer today because I'm on the road, and I think I didn't realize that was in the system. So I was like, here, every week my title changes, my name changes on here.
Well, I've gotten so used to the mortgage guru, so
I that's my favorite one,
Yeah. So we've got a lot of news coming out, again this week. Of course, we had Jerome Powell yesterday in the Fed, and I actually got a chance to watch the news conference live. And for someone who's trying to invoke confidence in the banking system, came across really weak.
Oh, he was not confident yesterday, was he? My goodness.
No. When you're doing a presentation, you want to, be boisterous, you stand tall. And he was very meek in both his mannerisms. He's a quiet person anyways.
Yeah.
But in his mannerisms and his vocal content, he really just kind of avoided a ton of questions.
Yeah.
And that didn't invoke a whole lot of confidence in me. Not at all. I think the couple of major points that I took out of it is they're really not sure which way to go, because you've got banks in trouble because of the increase in the interest rates.
Yep.
He doubled down on getting employment to 4.5%.
Yep.
Which is about, I think it was between 1.4 and 2 million people losing their jobs by the end of the year.
Yep.
And then he just kind of totally avoided what a lot of people are starting to look at, which is the commercial mortgage-backed securities, the CMBSs.
Yep.
Which, he totally blew off that question, just right over his head. Which a lot of people are starting to bring up that, hey, the exposure on these is a lot bigger than even on some of the bond situations that we currently have. So I walked away going, not sure what's going to happen. He kind of said that they may back off the rates. But he did say their projected is 5.1 for the end of the year.
Yeah, which means a little bit of change.
Yeah, it means you're probably going to get another, at this point, another quarter of a point before it tops out, somewhere in that ballpark. So, but he also felt that the bank runs are going to help tighten the overall credit available out there, because as the banks get fearful of all this exposure, they're going to start tightening their requirements on their lending. And I've actually read some stories recently where a number of the credit card companies are starting to lower the limits on people. So he felt that alone, that as well as the increase in the rates could actually be enough to tighten things down without possibly too much more rate increases. So, when we look at the where the betting game is going right now, is probabilities at the next meeting, which is actually 41 days away. You got 55% of the people are saying no change to the rates. And you got 44% right now saying that they're going to increase it. It looks like a quarter of a point. I think it really depends on what happens with the banks.
Yeah, I think that's where we are. Like you said, there's so much data that's not being accounted for. Like it's going to be like it's kind of a weird piece, is because we've been so focused on the residential side that a lot of this has, like you said, we've been ignoring the commercial side of how that can play into and how that's going to spill in. And the commercial side, when you have some defaults on the residential side, they're relatively small a lot of times. Commercial side, like a little defaults on a commercial side, these are big numbers that can hit, which can have really big impacts to the bottom line and to the budgets and to the balance sheet of these banks. So you can see a big, I think, I could see us, I mean, I see an avenue where I could see the Fed not making another increase this year, you know, and I can also see an avenue where the Fed makes, another half a point to 3/4 of a point. I don't think we're going to see another full point.
No, I don't think we can do it.
Yeah. And that's the hard part is, as you mentioned, I felt like Powell came into this conversation and he backed away in some different areas and he wasn't very confident. He kind of, and that kind of like the markets yesterday really responded positively to what happened yesterday. But it was funny because Monday and Tuesday, the markets were they were ready for the worst. So like they were getting worse, like big, a lot of worsening Monday and Tuesday. And then we kind of just saw Wednesday after the Fed's talk kind of all gain back and kind of head to where we were on Monday before all the worsening. So I think it's kind of like, okay, this was better than what we were hoping for. But it's kind of like, I don't know. Like you kind of, when you don't have confidence, when you can tell Powell doesn't have confidence, it leaves us kind of stuck in I feel like they don't know what they want to do. So now I'm kind of like, I don't know what they're going to do. Like,
you don't. And then Janet Yellen was actually at another meeting at the exact same time and basically kind of bluntly said, we're not going to protect the regional banks.
Yeah.
Deposits aren't going to be secured. And it's like, okay.
That's but they said a precedent that they would.
Yeah.
And then it's like, now we're not. Like, I get they probably have to take a stance of like, okay, we did it this one time, but it's like, my goodness, I don't know what to say there.
Yeah. I don't like when the government gets to pick the winners and losers.
Yeah. That's exactly what it sounded like was happening right here. It's like, hey, like, these people are going to be okay. And it sounds like they're going to basically pick and choose who they want to protect. And unfortunately, usually that means that, the lobbyists, the people spending more money, they're going to be the ones protected. So, you may see some regional banks that maybe are dealing with more like, agricultural sectors and this and that. Those may be the ones that they're like, we'll let that go.
Yeah.
And then the ones that are dealing with more tech side of things, there'll be the ones that, or pharmaceutical type things and stuff like that. Those will be the ones protected.
Yeah. Well, the bank situation isn't over yet.
Yeah.
Here's another one of the big regionals, Pac West. 20% of their deposits dropped.
Ooh.
So that I would consider a bank run, and they've had to go out, much like SVB tried to do, and raise funds.
Yep.
So I know they've gone back. I believe it's to the repo, got 12 billion there, got from the new program. I think they said they got another 4 billion there, and then yesterday they actually had to go to a hedge fund and raised over another $1 billion there.
Oh my goodness!
So
it's a lot of money they're raising.
That's a lot of money.
And
you got to pay that back too.
Yeah.
So, I mean, these banks, this bank situation isn't done yet.
Nope.
And that's where I think Powell's losing a lot of confidence, is because he's stuck between a rock and a hard place. Do you go to like the 1923 situation where you had hyperinflation, or do you go to the 1929 situation where you had bank runs and collapse the economy, depression?
Can we stay in between those? Can we just?
I mean, that's where we're stuck right now. You feel like you're stuck in the middle of the road, and
Yeah.
traffic's coming both ways.
Yeah.
And you're gonna get smacked either way you go. You know? So,
yeah, and the hard part about this is and I hate to say it, it's like, there's a small contingency of people that'll feel this, right? If one of those happens, and they'll feel it for a day or two. But there's a lot of contingency of people that are sitting in the middle and the lower, like on the income scales, that'll feel it for months and years.
Yeah.
If something like that happens. And that's the hard part. That's really the hard part about this is like, they're not going to they're not going to do something that just greatly impacts, and only the top get impacted, or like, but that's the hard part is when you're at the top of the food scale, like, food system, you can weather the storm. Mm-hmm. And it may only impact you a day or two or a month. It's everybody else that's going to feel the brunt of this if they go into one of those extremes. And that's where I hope that Powell is really, really focused on, is making sure that we don't hit an extreme that's going to completely, because I think that's, if you really negatively impact the middle and the lower, you're going to see this spiral much, much further, and it's going to spiral much, much longer.
Yeah. Yeah. I mean, you don't want to see, they call it a recession when your friends gets laid off. Depression is when you get laid off. But when you look at that number that he's saying is, hey, we've got to get unemployment up to 4.5%, and you're going to, you have a maximum of 2 million people. It's like, and how do you stop it? Once it starts rolling, how do you stop it?
Yeah. And that's
how do you stop it going to 5%, 5.5%, 6%?
Mm-hmm. And that's that key right there. Is that, and I think that's the part that, and I'm sure they're looking at it, but that's the part that's not being answered. Is it's not like a magical number where you can be like, hey, we're going to go from this to that. Like, that's such a massive change. Yep. And I get it. Like, a healthy economy, if we're under 5%, that's still a healthy economy and all. But if it's an abrupt boom, we're going to pick this number up 2 million plus people in 6 months time, that's not healthy. And that 2 million, now you're going to see businesses immediately react to that, get more conservative across the board, which we've seen on the tech sector. We've seen the tech sector already sit there and see what Google and Amazon, all these different companies are doing, where it's like, oh, revenues are down, we've got it, and they get hyper conservative. Right. And they're letting go, and it's like, all right, now it's like
Amazon just announced 90,000 layoffs.
Oh, right. That's a big number.
I mean, Powell should be calling up and say, thank you. You just took 1/10 of my number. I appreciate that.
Right.
But an additional 90,000 layoffs.
Yeah. That's
but and that's one of those where you got a big company, it trickles down locally. It's like, okay, now all these people who are working at that location for Amazon aren't going to that restaurant.
Yep.
To get meals. So guess what? Now they don't need as many waiters and waitresses.
They're not taking vacations. They're not buying new cars. They're not doing this. They're not going to the store and buying new technology. Like, it has an impact, and that impact has it's a snowball. And that's the part that I think a lot of people are like, and I think what they're looking at it in a bubble, and they're saying, well, this is still okay. And they're not going, well, where are we now to where do we want to go? Will that have a bigger impact? Will
and you can see the stress on the American consumer.
Mm-hmm.
When you look at, credit card debt has just exploded.
Yeah, massive. Like, it's the highest it's been.
We have $1 trillion in credit card debt in this country. Yep. It was on the down slope. And
you know what? Forget about student loan repayment. Let's just wipe everybody's credit card debt.
No kidding. It's like, wow, $1 trillion. And it's just, and when you see the graph, the spike is, just out the window.
Let's just go to a model. We're just going to give 50% of our income to the government, and then nobody will have money to spend anyways.
Oh, that's like my brother in New York, in Westchester County. We actually calculated, and he's like 64% of his income from taxes of some sort or another. I'm
There
like,
you
wow, I
go.
can make so much more than me.
Yeah, and he's like, I hope you enjoy that noodle in a bowl,
Yeah.
noodle in a cup.
Yep.
Um, but no, like I think that's where we're kind of seeing this, and we're going to see an impact. But what's crazy is what locally, what are we seeing still?
We're just steadiness. No real peaks, no real valleys,
Mm-hmm.
but a slow steadiness,
Yeah.
in the overall market. And you haven't really seen the construction slow down, which is always a big thing. That's what you
Yep.
look at first. You look at that commercial construction, and we're still seeing new project here, new project there, new project here.
Yep.
Talked to a plumbing company the other day, um, Mr. Cox, and it was, no, we're booked out for like 18 months.
It's not bad.
That's not bad.
So the question is if we talk to him in 6 months and he says we're booked out for 12 months, then we have to worry.
Then you have to worry. Yep. Yep. Then you have to worry. But the other thing is interesting is you look at the T bill, and we're kind of, it's a little volatile, but we're sitting in a range at least.
Yeah.
We're not jumping all over the place. And
yeah,
we're sitting back where down around 6.5 roughly.
Yeah, on rates, yeah. I mean 6.5. Well, here's the hard part is because it's so volatile, we're not seeing those rates kind of like we're not seeing investors play as nice. Because they're scared. They're scared to get aggressive with their pricing because they don't know because it's flipped. You're talking in the last, we've seen 30, 40 bip spikes on the 30-year.
Yep.
In an hour or two. I was laughing on Tuesday, literally, I think it was like 3:10 p.m. We saw a 50 bip spike into the negative, like just in a blink in 10 minutes. And then over the next 2 hours, it kind of bounced back up. And I was like, holy cow, what the heck just happened? And I'm trying to find information on what happened. And there wasn't really anything big that caused it. It was just, we had some auctions that didn't go as well. But I think it was kind of just like oh crap. And I think somebody sold, like somebody liquidated quickly. And then, and then it had to be bought up type thing.
Yep. Yep. Yeah. I mean, if we look, we really kind of sit in that range, low 3.4, did come back up here to a little over 3.5, but kind of sitting in a range where you can feel a little steadier on your interest rates overall. You may lose an eighth here or gain, get an eighth back here, but you're not jumping all over the place like we had where 7 one day, 6.25 the next day, 6.75 the next day. And going into the spring, it's nice. I think a lot of people, seven's like that fear number.
It's a psychological threshold. It is. It's amazing how, because like usually in rate movement, like, going from like 3 to 4 would have been a psychological, but we blew by that so fast.
Yeah, we didn't
it was like,
look at those.
we couldn't even worry about those, but 7 was the point. And I think that's where the hard part is like, there's so much time spent in the 3s that 7 was like, this is double what it was. Like, I think that's where psychologically a lot of people were thinking, it's like, oh my gosh, this is double. And that my interest rate's twice as big as what it was. And a lot of people have that apprehension, but you keep it in the 6s, and I think we're going to be okay. I'd love to see them back in the 5s. But I think we've got a shot this year to kind of touch it and to kind of sit at that top side of the 5s. But it's really going to depend on, and, we all know this, like it's going to depend on what kind of happens. And, I think if what Powell wants happens, we'll see the 5s.
Yep.
But I don't think I want that to happen. I'd rather stay in the 6s and not have that.
Yeah. So getting into our numbers, just like we said, steadiness, throughout the Orlando area. So, the price actually jumped up a little bit. Average price 4.5%. I think that's from we're seeing less discounts being given.
Probably.
Yeah.
Because
Inventory,
inventory's dropped.
yeah, drop 43, but still, I kind of look at it as kind of like a flat line.
Yeah.
So, but here's the big thing again. We always, we look at every week is what is the original list sales price and the final list sales price percentage wise. And
Mm-hmm.
again, we're creeping back up. We're up to almost 95% here on the original.
Yep.
And then on the final, they've came back about a half a point. We're sitting just below, I think, 97 last week. We're now 97 and a half. So you're seeing less discount. Reason for that comes back to, inventory again.
Mm-hmm.
So, and here we are. I mean, we look at it, it's just sitting here. We're not getting the influx of new homes that normally this time of year
we get. Do you think, and I know we've talked about this, but do you get that little snobbiness, like that meme that we've seen of like the proper English guy is like me looking at people that don't have the 2.7, like,
Yes.
that I feel like there's a lot of people right now going, I would move, but I have a 2.75. Like, what am I going to do? And what they're choosing instead to do is be like, I'm going to turn it into a rental.
Yep. Yeah.
And
let me take advantage of this because, I can go, here in my neighborhood, my gosh, 1,800 square feet rent for $2,500 to $3,000.
Now, what I do think will happen is, and this is me being thinking a little bit, we're different than a lot of markets, right? Borrowers can qualify and their tax bill doesn't adjust right away because we have homestead. So I think you're going to have a lot of people that were like, my rate's great, I'm going to rent it. And then next year when it's no longer their homestead, that tax bill is going to skyrocket and they're going to be like, oh crap, it's not worth renting.
Yes.
And then you're going to see. So I think next year we may see an influx.
That's a great point because I was doing a calculation for a couple looking to purchase a home in the land that had been homesteaded. Gentleman had it for 20 years. He was paying like $1,300 on his taxes. And we put it into the calculator. Theirs will jump to roughly about $5,200 with the homestead. And it's like, I gotta make you aware of this is because this guy's owned it from like 1997 or something like that. I think it was.
Great rental year one, and that's the thing. Still probably a good rental year two, but you go from, and that's like a lot of people, they can't, if they get a rental and they have a property manager and they go from making $600 a month profit to making $100 a month profit.
Yeah,
they can't afford it. They can't afford for something to go wrong at that point.
Exactly.
Right. And we know that 600, they're not utilizing that forever. So I think that's where you're going to see a little bit of like, ooh, what's going to happen here long term. And I think we will see, and it's a delayed, I think it's going to be delayed, is we're going to see people that turned into rentals, rented it out for a year, maybe two, and then they're like, okay, it's just not worth it anymore. It's not worth the headache is what'll happen. So I think that's where we'll see some adjustment.
Yeah, that's a great point. That's an excellent point. So inventory's kind of flat, hoping it'll start to pick up. But like the one I've got a listing going live this weekend, but it's a situation where she's 86 and it's time to move her, closer to the family. And that's why they're selling. It's not because they necessarily wanted to, but it's that time for her. She can't live on her own anymore. It's a beautiful townhome, 2-story townhome. And they're just too worried about her falling and getting hurt and stuff like that. Yeah. So it's not a necessity, or it's not a want to. It's a necessity situation.
Yep. Gotcha. Yep. Exactly.
And I think that's what most of the listings we're seeing right now. That's what we're getting. Overall.
Yeah, you're getting people that have to move, like something is impacting where they don't have an option not to move.
Yep. And then, at our average days on market, we're still holding up there, in that 60 range.
Mm-hmm.
So we did see that drop, which of course I think was due to the interest rates
Yep.
dropping.
Yep.
But I pulled this up this week because I just wanted to take a look at February numbers, doing comparisons year over year, because last year was a totally different market. And
Oh yeah.
it's interesting to actually look at this, because inventory wise, we were up 140% over 2022. We actually had more homes going on the market though than currently. Why was that? Because you knew you could sell your house in a day.
Yep. And you were going to get a phenomenal, and it was going to be everybody was going to jump to bid on it. So your house was worth 300. You knew you had a shot to get 350.
Yep. Exactly. Average price, we're up about 9.3%. But what's interesting is we're starting to get away from the peak. So you're going to start seeing this number drop down over time. Median price really isn't that much different though.
Yeah.
But look at your volume. You're about 300 million less. And then your average days on market, we've more than doubled.
Yep.
Average days on market.
Yep.
So you look at this and you realize, man, it's a total different market.
Yeah, 100%.
Than it was 12 months ago. Totally different. So the way you approach everything has got to change.
Yep, exactly.
So keeps us on our toes.
Always got to stay on our toes.
Yeah,
that's just the way it is.
Well, listen, I know you're on a tight schedule today.
Yes. I'm actually sitting into what is like a closet. It's a small office, but I'm actually teaching a class, and I was supposed to. My business partner's teaching the first half, and I got the second half. So I appreciate it. But I wanted to be on this. I think we had some good info. Different. It's the energy was different this week, right? Kind of followed Powell's energy this week. But
you want to bring good news. You want to bring good news, but you also got to bring the truth and reality to the market.
Absolutely.
And we're just kind of in a sit and wait. Rates are holding good. It's not a bad time. Inventory levels could be a little bit higher, but I'll tell you what, there's some builder incentives out there that are just knocking the socks off right now.
I know.
And price reductions. And their price reductions are amazing. Yeah. So there's always opportunities. Always.
Absolutely.
So, hey, listen, take care. Have a wonderful day. Everyone, thank you for joining us. Again, YouTube, hit the thumbs up. Appreciate it. Subscribe and like. Talk to you later, man.
Knock it out, guys.
Bye.